When bonds were supposed to protect you, SCHO lost just 6%, while FBND crashed 17%. SCHO recovered in under 2 years, but FBND investors waited nearly 3 years to break even. SCHO crushed FBND over 5 years, 9% versus just 3.4%. That's less than half the return. Over 3 years, FBND edges ahead at 15%, while SCHO nearly matches it at 14%, practically neck and neck. SCHO ran steady while FBND stumbled early, then sprinted late. In marathons, consistent pacing usually beats dramatic swings. Lesson for your portfolio strategy here. FBND's crushing it with 7% returns, outpacing SCHO's 5% by over 2 percentage points. Both funds destroyed value when adjusted for risk. SCHO's -1. Sharpe ratio is particularly brutal here. Both funds show negative Sortino ratios, SCHO at -1.5, FBND at -0.7, meaning neither compensated you for downside risk. Negative Sharpe ratios mean you'd have made more money sitting in safe treasury bills than these funds. Think of risk-adjusted returns like getting your report card. Both funds failed when you grade them on the risk they took for those returns. SCHO costs just 0.03%, while FBND charges 12 times more at 0.36% for essentially the same investment. That fee difference quietly steals 10% of your wealth over 30 years, compounding costs you can't ignore. SCHO's portfolio turnover is nearly 3 times lower than FBND's, which means you're paying far less in hidden trading costs. 3 pennies versus 36 pennies per $100 sounds tiny, right? But that's couch change that'll cost you thousands over a decade of investing. SCHO's rock solid at 1.9% volatility, while FBND swings wildly at 6%, triple the price instability you'd experience. SCHO's calm 1.9% volatility versus FBND's 6% means you'll sleep better watching your account daily. SCHO's 6% drop looks mild until you see FBND crash 17%, nearly 3 times worse. SCHO wins on returns and expenses with rock-bottom costs at 0.03%, but both funds stumbled badly when we adjusted for risk. That's the real concern. Think roller coaster rides. SCHO's your gentle kiddie coaster with smooth hills, while FBND's that white-knuckle drop that makes your stomach flip. Same park, wildly different thrills. FBND's nearly 3-year recovery from a 17% crash means you're sidelined while markets hit new highs. FBND's worst year was more than 3 times worse, a negative 13% versus SCHO's negative 4% drop. FBND's negative 13% forces you to sell at rock bottom. SCHO's negative 3.9% protects your retirement nest egg. SCHO's zero correlation means it moves independently from stocks, perfect for balancing your portfolio's ups and downs. Think of correlation like dance partners. SCHO moves independently when stocks drop, while FBND follows partway down. Zero correlation means true diversification in your portfolio. SCHO's zero correlation means true independence when stocks crash. FBND's 0.3 still gets dragged down with them. SCHO wins on 5-year performance and costs, while FBND rebounds faster but with higher expenses and deeper crashes. So which fund's right for you? SCHO's your safe harbor, while FBND's got momentum but swings harder. SCHO's your steady ride for the long haul, efficient and reliable. FBND's more exciting but demands attention and costs you more to operate. Standard legal disclaimer. Educational purposes only. Past performance doesn't guarantee future results. Do your own research. If you enjoyed these weekly bond fund breakdowns, hit subscribe for more data-driven, fixed income comparisons.